Let's start with the dollar right there, because we have seen this huge correlation between the dollar and U.S. stocks, as this GTV chart on the Bloomberg shows. And not surprisingly, as we had U.S. stocks selling off today, we saw strengthening of the U.S. dollar, rising the most since April. I do wonder, though, how long this could last, because as Sophie just mentioned, it seems that we're looking at some larger structural downtrends here.
Yeah, let's talk about where we are today versus where we were 3 months ago. So back in early March, we had a situation where there were no swap lines. The Fed had really just begun to implement its emergency measures. The public health situation was very much the same in nearly every G10 economy. It was bad and getting worse. And we had no recovery fund proposal from Merkel and Macron. So very much euro negative. We saw the euro fall 8 cents over a very short period of time. So fast forward to today, the euro is once again sitting at 114. Big question is, do we go back to 106? Difference now is we have swap lines, we have Fed emergency liquidity programs, we have the recovery fund proposal, and the public health situation in Europe looks much healthier than it does in the United States. So I think dips in the euro are likely to be very shallow. We recommend buying the euro on those dips, and we do see more dollar downside against most currencies over the next couple of weeks.
We have started to see the sell-off across Asia, especially when it comes to the Aussie and the Kiwi dollar. So what are you looking at right now?
Yeah, so one of the things we recommended today was buying the euro against some of these higher beta currencies like the Canadian dollar, like the Australian dollar, because a lot of the run-up in these currencies has been so tied to the S&P 500 or really global stocks more generally. It's been almost monotonic on the charts. So we really prefer to buy that safer currency that now has a lot of that tail risk removed, like the euro, against some of these higher risk currencies with stocks looking a little shaky here.
So do you see commodities pairs returning to outperformance, given that the domestic stories for some of these economies are pretty resilient, the likes of New Zealand and Australia potentially recovering quicker, and I suppose at a more independent pace compared to the rest of the world?
Yeah, so one of the big things that Australia and New Zealand benefit from, at least in this current environment, is exposure to China. And in particular, when we think about Australia, it's exposure to Chinese industrial sector, which has had the closest thing you can get to a V-shaped recovery. So with Australia sending a lot of iron, coal, other sort of imports into that Chinese industrial process, it's very well positioned economically in this scenario. It's one of the reasons that we recommended sort of favoring the Australian dollar and New Zealand dollar over something like the Canadian dollar, which is more exposed to the U.S., and moreover, it's more exposed to oil prices, which look more vulnerable than some of those Kiwi and Aussie commodity prices.
Tell me about your conviction when it comes to the Swissy then.
The Swiss franc is really well positioned right now. For one, it's tied to the euro, which again is fundamentally a lot better position than it was 3 months ago. And moreover, it's a safe haven. And we've seen really strong buying interest in the past couple of days, even despite the improvement in risk sentiment over just the last couple of weeks or so. And we're almost back to where we were on Euro Swiss just a couple of months ago. So that, to me, suggests a very strong structural demand for Swiss francs. And I think even if you do see the dollar continue to gain in the short term, we think the Swiss franc can still outperform versus the dollar.
Let's talk about underperforming, because just in the last couple of hours, we just heard that the UK will formally rule out an extension to the Brexit deadline. So really, with so much uncertainty over where the UK is headed, can anybody be positive on the pound right now?
Yeah, you have to be very careful with sterling around Brexit deadlines, because we have certainly seen this movie before where the UK swears off extensions. It's one of the reasons that we like to play sterling via the options market. So in particular in euro sterling, where we see relatively subdued volatility compared to most prior Brexit deadline periods. So we like to buy sort of protection either direction, because you could very well see an imminent agreement, given now the higher level officials like Johnson and von der Leyen are involved, or you could see it turn pear-shaped very quickly. So we really like options-based protection there.
And let's turn to China, because We have seen now the offshore yuan, of course, with all of the uncertainty right now, underperforming. But just recently, we had seen it holding steady, given that we saw some positive noise on the trade front as well. So what are you watching to see where the yuan is headed?
Yeah, so the U.S.-China developments recently have been, they've definitely been negative, but what's really key is that they have not been focused on the economics and the trade agreement. Until that changes, I'm not really worried about the Chinese yuan weakening very much. Interestingly enough, it's actually been weakening on a trade-weighted basis, though, which I think is more important when we think about what it means for the Chinese economy and, moreover, what it means for sort of how the U.S. looks at China. If you see more trade-weighted weakening, that could start to draw the ire of the United States. That's something to watch out for.
Erik, thoughts on Carl Bass and his enduring I guess, expectation that we're going to see a collapse in the dollar peg in Hong Kong?
Well, right now it's, of course, trading toward the stronger end of the band, but we've seen that flip very quickly in the other direction in the past. Ultimately, it's a political decision. Right now, the fundamentals point to Hong Kong dollar strength versus the dollar, and that's, in fact, what we're seeing. But it all really comes down to, what does China want? And if they really want to depeg the Hong Kong dollar from the U.S. dollar, that, to me, would be sort of them signaling they have given up on Hong Kong as a financial hub that really focuses on doing business in dollars. And I think we're a long way from that right now. So I have a fairly high conviction view that Hong Kong dollar peg will hold for the time being.